In recent days, there's been a lot of speculation on whether the stock market will crash or not. And the market, for the most part, stayed resilient, even with the rapid increase in interest rate. And so today, I want to dive deep into the potential reasons behind this phenomenon and some insightful data that could hint to what the market might actually do in the future. So let's get started with the rapid rise in interest rates. But before we do, please hit that like button and stay updated by subscribing. So historically, the US has never seen such a swift increase in interest rates as it has recently. In fact, the rate has risen by 4.88 percentage points in a short span, which is unprecedented. This rapid rise has led many to believe that the market crash is imminent, and I'm going to give you some data that might show otherwise. Now, this has a ripple effect, especially in the housing market, with a lot of buyer and seller uncertainty. However, the market has remained relatively stable, and one might ask the question why. So let's consider the role of 7 major players and major corporations: Meta, which is Facebook, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. These 7 companies alone constitutes 28% of the total S&P 500. Their year-to-date returns are a staggering 92%. Even if these 7 companies were removed from the equation, the S&P 500 would actually be in the negative. And this means that the 7 giants are essentially holding up the entire stock market. Now, the fact that such a small number of companies constitute such a large portion of the market could indicate that supposed health of the market is mostly an illusion. So what is the state of smaller companies or corporations today? Well, while the giants thrive, smaller companies are struggling. And the Russell 2000, which represents companies with a market cap between 300 million to 2 billion, is only up by 7% this year. And even worse, the microcap companies valued between 50 million to 300 million are down by 1.85%. Now, this disparity indicates that while the bigger companies can weather economic storms, smaller entities are feeling the pinch, and in many cases being pushed out of the market completely. Okay, so now let's take a look at the data from an individual consumer. Another alarming statistic is the US consumer credit card debt, which has surpassed $1 trillion. And as interest rates continue to rise, so do credit card interest rates, which means consumers are now facing higher monthly payments, which could lead to increased defaults in the future. Now, the difference between credit card rates and the 5-year US Treasury is actually widening, indicating that credit card payments are becoming more burdensome for the average consumer, which can quickly and detrimentally trickle into other areas of the market, creating an exponential effect on our market's weak points, such as those that we've already talked about, right? Okay, so now let's consider more consumer debt, things like student loans. Now, aiding to the financial strain on consumers is this impeding reassumption of student loan payments. The government had deferred these payments during the pandemic, but they're currently being reassumed for millions of Americans. And this will impact 30 to 40 million Americans, further straining their financial resources, decreasing consumer spending power, and creating even further market uncertainty. So, what does all of this mean? Well, while the stock market hasn't crashed yet, there are underlying factors that could lead to instability in the future, and may even in the very near future. The reliance on new major companies to uphold the market, combined with increasing financial burdens on consumers, paints a concerning picture. In situations like this, sometimes only the paranoid survive in such scenarios, and it's essential to be vigilant, diversifying investments, and obviously you want to prepare for all possible outcomes. So make sure again, guys, to hit that like button or subscribe if this is a topic of interest, and we will see you on the next release.